Hi there, welcome to Kneppy Invest. In today's video, I am going to talk about Channel 9. To be more accurate, 9 Entertainment. And if I ask you a question about this company, you'll probably say they are a TV station. But saying they're just a TV station is probably not doing this company justice because they are a lot more than just a TV station. For full disclosure purposes, I am not a shareholder of Nine Entertainment. I have never been a shareholder of Nine Entertainment. And more than likely, unless I see really good value and share price in an uptrend, I probably will never be a shareholder of this company. I just don't like the space they're in. However, Channel 9 and the management of this company have been doing a wonderful job of diversifying and expanding their products and services. So if I did have to pick one of the TV stations to invest in, and I don't think you can invest in ABC, you can't invest in Channel 10 anymore, you can invest in 7. So between 9 and 7, I probably would pick 9. Nine Entertainment are a diversified media company with assets in radio, publishing, print, and that sort of thing. And also, they have streaming service. Now, among their TV sort of services or products, one of my favorite is Channel 9 now, which is their on demand service. Now, I don't watch traditional TV anymore. I don't sit myself in front of a TV and watch programs on Channel 9, Channel 7, 10, SBS, or ABC with ads in it, apart from ABC, of course, they shouldn't have ads. That's not the way I do it. But you can get access to Channel 9 programs through their on-demand site. You could just go online, Channel 9 now, and that is how I do watch some Channel 9 programs. So they are diversified. They also, in publishing, own The Age, Sydney Morning Herald, AFR, Brisbane Times, which is only online. There is not a print edition of that. And among their radio stations, they own 2GB, 4BC, 3AW, and 6PR. The current CEO of Channel 9 or 9 Entertainment is Mike Sneesby. He's been in this role and a director of 9 since April 2021. I don't know anything about Mike Sneesby, so you go through his history here, and it is a sort of impressive history with lots of positions, particularly within the sort of the media area. So, for instance, he spent his early career in leadership and consulting positions, gaining broad experience in digital media, technology, and communications in Australia, Asia, and USA. The main reason I don't really care about the CEO is I'm not going to take a position in this company because of management. It's only going to be because of value, if I see really good value, and if I see the share price in an uptrend. And if I do take a position in this company, more than likely it's going to only be for the short to medium term. I don't think, in my opinion, this is a long-term buy and hold sort of company. And it should be no surprise, since I wouldn't consider holding Nine Entertainment for the long term. I don't have the highest regard for the quality of this business. So I don't think it is a high quality business. Now, I wouldn't say it's one of the lowest quality businesses on the ASX, so sort of in between. And because it is in between the high quality companies and low quality companies, I would look at value and also look at the trend in this company. And if I did see potential good value in this company, I wouldn't automatically take a position. I'd wait for the trend in the share price and the sentiment in this company to turn around before I even think about taking a position in this company. Now on to the financial year 22 results for Nine Entertainment. At the end of trading on December 23, the 23rd, the last trading day before the Christmas break, the share price of Nine Entertainment was $1.88, which gave it a markup of $3.2 billion, which is an intriguing valuation when you look at some of the financial numbers in financial year 22 for this company. So revenue $2.7 billion, but the profit was $297 million. Compared to the markup, the PE ratio of this company is heading or very close to 10. And then you look at the operating cash flow and free cash flow greater than $400 million, which means those sort of metrics compared to the value of this company are looking quite attractive now. So we will look at the valuation metrics later in the video. So I would say, just based off valuation, Nine Entertainment is looking quite intriguing right now. One of the ways I determine whether a company is high quality or low quality is just by looking at the revenue. Is revenue growing through time? Has it been consistently growing through time over a period of years, say 10 years or so? And if it has, that's a good sign the company might be on the highest quality side or spectrum. When we look at the revenue growth for Nine, we have seen it growing over the past 5 years since 2017. Now, Nine Entertainment listed on the ASX about 8 or 9 years ago, so not 10 years ago. So we don't know, we can't calculate the compound annual growth rate in revenue over the past 10 years. But over the past 5 years, revenue per share has grown at 0.4%, which is fairly low. And over the last 3 years, at 4.5%. So it is a fairly low growth rate in revenue per share. It looks a little bit better when you look at the overall revenue growth. It has grown from 1.4 billion to 2.7 billion over the past 5 years. So that's a doubling in revenue over that period of time. The other interesting aspect about Nine Entertainment is the growth in gross margins over the past 5 years, increasing from about 10% in 2017 to 25.8%. So that is an intriguing aspect of how Nine Entertainment has been performing over the past 5 years. And if they can continue growing the gross margins, this company would be looking even more intriguing. But I do have some doubt whether they can do that moving forward. Another way I determine the quality of a company is just by looking at dividends. And if we see dividends growing at a nice rate over time, that is a good sign that the company is high quality. If, on the other hand, we see dividends going nowhere or actually decreasing, that's a pretty good sign that a company is on the lower quality end of the spectrum. Now, if we take a look at Nine Entertainment's dividend history, going back to 2014 when they did list on the ASX, dividends haven't grown all that much. In fact, in between 2015 and 2021, dividends didn't go anywhere or almost anywhere. There was an increase in dividends in financial year 22, which saw the dividend yield increase to 7% for this company. So that is another potential attractive thing about Nine Entertainment is the dividend yield. And that dividend yield moving forward would be on the assumption that this company keeps on growing their profit and would maintain the dividends we saw in financial year 22. I don't have any opinion whether they can do that. I think more than likely they can. And if they can, the share price falling down to $1.88, below $2, with an attractive valuation metrics right now, potentially for income earners or income investors, Nine Entertainment could be an attractive buy. Now onto the financial performance of a few of Nine Entertainment's different divisions or segments. We won't have a look at all of them, just a few of the more interesting one. The first one is free-to-air television. Now, revenue did grow, and I would say most of the revenue is through advertising. They've also mentioned here the highest margins for 10 plus years. Now, even though they have highlighted that, that's not necessarily an attractive thing because that would lead to the possibility with saying going back to the mean or mean reversion that margins might drop over the next few years. But revenue has grown 7% from financial year 21. Costs have only grown at 5%, which means margins have grown at 1.5 points to 25.5%. Now onto the part of Nine Entertainment that I do find quite intriguing. That is Nine Now, their video on demand. I do use this quite frequently. I go to Nine Now all the time. You do have to sign in, that sort of thing, so you do need an account. But I use Nine Now for live streaming of sport quite often. And I do believe, in my opinion, this should be a high growth area and a focus for management in the future. It does seem like they are focusing on live streaming of events, particularly sport events. Now, right down the bottom here, they've mentioned significant investment in build out of live streaming infrastructure as the business continues to evolve. And in my opinion, most TV stations should be focusing on sport. Now on to the impressive growth numbers for Nine Now. Revenue up 41% from 107 million to 151 million. EBITDA up 37% from 73 million to 100.5 million. And the margins at 66.6%. significantly higher than the free to air, which was at 25%. So you can see probably why I'm more fascinated with Nine now than the free to air aspect of Nine Entertainment Group. Now onto their streaming service, Stan. I don't subscribe to Stan, but they do have more than 2.5 million active subscribers. Revenue has grown at 22% from 311 million to 381 million. EBITDA actually fell from 39 million to 28.5 million. And the most important thing about Stan, and probably the reason why I'm not that excited about this particular thing in regards to Nine Entertainment Group, is the margins. Only 7.5% margins in financial year 22, down from 12.7% in financial year 21. So if I was excited about one thing in regards to Nine Entertainment's TV division, it's definitely Nine now. Not particular Stan, not particular free-to-air. It's all about Nine now. Let's have a look at their publishing. This is interesting because when you compare the digital revenue to the print revenue, there is a big difference, particularly in the growth. So print revenue and print is dying slowly, while digital revenue should be growing, and it is growing at a fairly quick rate for Nine Entertainment. So their subscription and licensing grew, or the revenue grew 66% from 103 million to 171 million. Their advertising grew from 149 million to 164 million. But then you look at the print revenue, subscription down 6%, retail down 6%, advertising up 13%. Altogether or combined, really nice margins here at 30.2%, increasing from 23.2% in financial year 21. So the main thing I'd be interested in when it comes to Nine Publishing is their digital. How quick can they grow their digital revenue? And it has been growing at a really impressive rate in the past year. Now onto the valuation metrics for Nine Entertainment, and this is where it does become intriguing for this company with a P/E ratio of only 10.8. Now, they have been growing their revenue per share at fairly slow rates. Their overall revenue has been growing at nice rates, but if they can really focus on, say, the Nine now and really grow that strongly, that would be interesting moving forward for this company. But I don't know how far or how much they can grow that aspect of the company. Price to sales ratio 1.2. And then we look at some intriguing valuation metrics like EV to EBIT, which is 9. So enterprise value is important because I want to take into account cash and debt. And 9 is low, but it can be lower. I'd be looking at, say, about 6 before I become really interested at taking a value position in this company if the share price starts to turn around. I did calculate a reverse D, or do a reverse DCF. What would the operating cash flow or earnings per share have to increase to justify the current valuation? And that was 12.9%. If you did do a reverse DCF on the operating cash flow and free cash flow, you get a significantly lower number. And I do think 12.9% growth for this company in terms of earnings per share would probably be a little bit too, what's the opposite of conservative? A little bit too enthusiastic in regards to this company's potential for growth in the future. Now onto the most recent trading update for Nine Entertainment Group, and they've broken this down into 5 different divisions or segments: television, audio, publishing, Stan, and domain. Nice growth in most of these, although the less bullish or most bearish area is domain. They mentioned here current market conditions, however, trending well below expectations, particularly in inner metro areas, and their previous financial year 23 cost guidance of low double-digit increase currently under review. Domain did release a negative trading update recently, and that could have led to a decrease in Nine Entertainment's share price. But the other 4 areas or divisions are seeing nice growth in the first quarter of financial year 23. Total television revenue up 9%, total radio ad revenue up 18%, quarter 1 subscription in total publishing growing 5%, advertising up 13%, and Stan has seen, well, they haven't reported any growth here, but they expect to report revenue and EBITDA growth in financial year 23, but they didn't actually say or provide any numbers. But overall, Nine Entertainment Group expects first half financial year 23 EBITDA to be around the lower end of their previous guidance, which would be around about $380 to say $390 million. Now onto the charts for Nine Entertainment Group. The first one here is the weekly chart going back to when they listed on the ASX. And sometimes when I'm not quite sure about the quality of a company, I will have a look at their long-term chart. And if I see the share price of a company going from the bottom left to the top right, that's an indication that a company is a higher quality company. For Nine Entertainment Group, share price has gone absolutely sideways over the past 8 years. When the company did list on the ASX, the share price was around $2. The share price now is just less than $2. So the share price has done absolutely nothing. So those shareholders who have held this company over the past 8 years have seen absolutely zero capital return. The only return they have seen from this company is the dividend. You also notice the share price has been volatile over the past 8 years. Share price has been as low as 80, or not quite 80 cents, but we'll say 82 cents. That was reached back in 2016 and also during the COVID-19 financial panic, while the share price has been as high as $3.13, which was reached towards the latter period of 2021, so just over 1 year ago. And if we take a look at the daily chart for Nine Entertainment Group going back to November last year, around the time we did see the share price reach that all-time high of about $3.13. The share price has been dropping during most of 2022, particularly from April. Back in March, we did see the share price hover around $3, and then the share price absolutely fell off a cliff between April and June, decreasing from $3 all the way down to a low of $1.75. The good thing, or good news for Nine Entertainment Group, we have not seen that low in June. We have not seen the share price get any lower than that low at $1.75. It has come close. It reached about $1.82 towards the end of September or start of October, and right now the share price is showing a little bit of weakness, pulling down from about $2.25 to a current share price of $1.88. Where the share price keeps on falling from here, maybe testing those lows in June, or maybe testing the low we saw back towards the end of September, remains to be seen. But the share price is in a downtrend right now. We can't, or at least, or at the very least, the share price is going sideways. So at this point in time, just based off trends, based off sentiment, no reason to take a position in this company unless you see really good value at current levels. I plan on continuing this Kneppy analysis series for a while, yet maybe forever, who knows. And the next 5 companies I'll be focusing in this series, or doing videos in this series, include Premium Investments, SG Fleet, I think is the next video. Do have it next to me. Yes, SG Fleet. And then I'll do Premium Investments, Kogan.com, Advancing Tech, and another really small company that I know nothing about, which is GLG Corporation, Gimli. So I'm really looking forward to having a look at that company because there is a little bit of positive sentiment driving the share price of that company higher. However, really low liquidity as well. So wouldn't be surprised to see the share price, which I think is about 50 cents, drop by 10-20% in one trading day because of the lack of any trading. So if you do have any suggestions of company you'd like me to feature in this video series, just leave it in the comment section of this video and I'll see what I'm able to do. That's all I have for this Kneppy's analysis of Nine Entertainment Group. If you do have any thoughts about this company or any other company on the ASX, you can just leave your thoughts in the comment section of this video. If you think I'm completely wrong about anything I said in this video, I'd love to hear you. So, for instance, someone in my Brambles video mentioned in the comment section that plastic pallets are absolutely awful. So I absolutely had no idea that there are people who think that, and this person is in that area. They are in that pallets area, so they probably would know. So maybe that's a reason why Brambles is moving away or not really getting interested in investing in plastic pallets. So if you are in this sector, you work in the media sector, and you know way more about Nine Entertainment, and I've said something wrong, I'd love to hear your thoughts. So leave that in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.